Joining me this Monday morning is Avinash Gorakshaka, Director Research, Profit Mart Securities. Good morning, Avinash. Thank you for joining us on News 9. Let me begin with the top story we are tracking today, and this as India's electric vehicle or EV industry accelerates. Two key government ministers have called for a shift away from reliance on subsidies. Speaking at a recent event, Union Commerce Minister Piyush Goyal and Union Minister for Road Transport and Highways Nitin Gadkari emphasized the need for the EV sector to build a competitive edge and become self-reliant. Goyal highlighted the success of initiatives like FAME 1, FAME 2 and the PLI schemes, but stressed the importance of moving beyond subsidies to ensure India's sustainable growth. Meanwhile, Gadkari echoed Goyal's sentiments, expressing that ongoing subsidies are not essential for the EV industry. Let's bring in Avinash here. Avinash, the EV sector in India hasn't really driven in the fast lane as it was expected to, and ICE cars continue to outsell in great numbers the EV cars. Withdrawal of subsidies, does it augur well for the EV sector?
Yeah, good morning, Karthik. I think you must understand that India is still a very new market as far as the electric vehicle market is concerned. I would believe that, if subsidies are withdrawn abruptly and all of them are not given to the manufacturers, then the scale of the opportunity is little difficult to be achieved, because today, as you rightly mentioned, the opportunity in the next 5 to 10 years is quite immense. I think people have understood the meaning of environment, clean energy. But I think today, if you look at the prices of most of the electric vehicle cars, I think, the pricing has definitely been on the higher side, and that has been the key reason there has been some stiff resistance for the demand to catch up. So I believe that, subsidies have to be phased out, but they need to be phased out in a gradual manner, because the industry needs to be encouraged and the industry needs to scale up the volumes, which are yet quite small. So I think you don't see electric vehicles in rural markets or typically tier 2, tier 3 markets, because clearly, unless volumes scale up and the opportunity to increase volumes goes up, then only the pricing per unit is going to come down, which most of the IC vehicles already enjoy. So I think, they are going to coexist. But obviously, the subsidy element will be important. So I think, the government may be thinking of reducing subsidies gradually, but any abrupt ending to the subsidy element would actually create a little bit of problems for new investment to come here.
New investment will, you're saying, be reliant at least on a gradual phase out of subsidies and not really abruptly cutting the subsidies. But keeping that in mind, Avinash, which are the stocks in focus for you from a long-term Indian auto sector story? Should we be bullish on, let's say, stocks like Tata Motors? Because that definitely seems to have the edge right now when it comes to electric vehicles, whereas companies like Maruti Suzuki, for example, have been laggards in the adoption of the EV story. How do you see the long-term view of India's auto sector, and which specific companies should investors keep their eyes on?
I think Tata Motors definitely looks very interesting, because within the electric vehicle market, they have a reasonably large market share of almost 40%. The second company could be Mahindra and Mahindra, which clearly has mentioned that by 2027, they are looking at 30 to 40% of their volumes coming from the electric vehicle segment. So I think, both these companies have invested a lot of money. They have created a solid product portfolio of electric vehicle cars. And I think, despite the fact that subsidies may get reduced in future, these companies are managed well. Their cash flows are pretty strong. So they know the fact that in the longer term, this market is going to flourish. So I think investors should obviously use any dip in the market to look at accumulating Tata Motors and Mahindra and Mahindra.
Tata Motors and Mahindra companies to look out for, and buy on dip is the strategy coming in from Avinash. Avinash, I want to just spend a little more on the electric vehicle industry globally, and we've seen that that even in the US or other countries in the developed market, there is this debate between hybrid and electric. Now, hybrid is something which actually does not feature much of a mention in the union ministers when they talk about India's energy efficiency and reduction of oil imports, and the focus is totally on EV. Is hybrid also an approach that you think India would be taking, and better now than later, before all the investments in electric are made?
No, I think the hybrid option definitely will be considered by electric vehicle manufacturers because this gives a fair amount of flexibility to them. And I think, as I mentioned earlier in my quote, that the IC and the typically the electric vehicle market is going to coexist together. It doesn't mean that if electric vehicle comes, the IC vehicles are going to completely go out of extension. My sense is that both will coexist, and therefore the emergence of hybrid will slowly take off in India. But I think for that also the industry requires a little bit of incentives, a little bit of concessions initially, because the scale and volume compared to other countries like China or US in India is extremely minuscule and very small. So I think volumes need to go up. I think over the next 5 to 10 years, hopefully once infrastructure is provided, more power facilities, specifically the charging facilities are provided, we may not see the volume growth significant. Only in metros and premier kind of locations, electric vehicle numbers are going up, but we don't see the same happening in rural markets. So I think, the point is initially some benefits and some concessions need to be given to manufacturers to incentivize this, this sector.
All right, well, some incentives should be given to the manufacturing sector. Stay with us, Avinash, as we move to the next story this morning. And all eyes now turn to the critical domestic indicators with November's WPI or Wholesale Price Index inflation data for December's flash figures for manufacturing and services PMI are set to guide the mood. Now, last month's WPI inflation saw a jump to a 4-month high of 2.36%, driven, of course, by soaring food prices, particularly vegetables, making today's numbers even more crucial in gauging India's economic momentum. Avinash, WPI numbers expected today. What is the mood on the markets, and how do you expect the data to really come out, and what it is going to tell us about the state of India's economy?
No, I think my sense is that inflation numbers, which were slightly elevated in the previous month, this month we could see a little bit of moderation. And I think the markets are obviously quite positive considering the fact that, whatever commentary comes in the Fed policy this time, I think markets will be obviously be looking at what the Fed governor does. Already the markets in US are factoring in a 25 basis cut. And the commentary there is going to be very important. Whether the Fed thinks of going for another 2 or 3 rate cuts is going to be very important. But I think after that, possibly the RBI governor here could take a cue, looking at the data points as he mentioned in this last policy, that inflation is very important. And now with the new governor coming in, I think most of them are looking forward that some good news would come in over the next, say, 3 to 4 months. So I think, these numbers are important, but I think there is some light at the end of the tunnel. We could see little moderation in food inflation, and that I think is a very good signal for the markets, because that clearly means that interest rates could get, cut, which has been a very long awaited demand from the industry.
Okay, so yeah, you're right. In fact, Avinash, you're joining a bunch of people who are expecting a rate cut in India to finally kick off. And the next RBI MPC, which is slated to be in the month of February, is actually going to be completion of 2 years since we've seen elevated rates. But you mentioned the US Fed and you mentioned the FOMC, which is slated to start tomorrow. Now, many industry watchers out there are saying that there isn't going to be as much to read in the rate cut in the US, and that pretty much is expected. But it's the Fed commentary which is likely to drive the mood of the market. Can you help our viewers understand what is the difference? I mean, a rate cut is a rate cut, great, but what else should they expect from the commentary of Jerome Powell when he announces the Fed's decision to cut or not cut rates?
No, I think my guess is, the bigger point to understand and analyze the Fed commentary is that what is the thought process from the government to ensure that, rate cuts are sustainable. I think if there are more than 2 rate cuts which are expected in 2025, then I think the markets could look at this as a kind of a very big positive surprise, because, whenever interest rates are cut, that helps the industries for boosting their profitability. And obviously that helps to, increase earnings growth. So I think, this is one crucial element which I think markets could see and would like to hear from Mr. Powell. I think the rate cut of 25 basis points, according to market reports, is already discounted. But I think if at all there are 2 or more interest rate cuts announced with a clear assertiveness from the governor, then I think that would be something which I think is important. And that is what the commentary is likely to be more important than purely the rate cut. If the commentary is going to be, cautious, and does not talk about any rate cuts going ahead, then I think the markets would obviously not look at this rate cut in any kind of positive way. So I think, this is the main difference. The event is important from the fact that what is going to come in future rather than what is going to be done, in the very near term.
Okay, and rate cut, no rate cut commentary notwithstanding, we've seen a bullish FII environment in the month of December. We have seen inflows coming into the Indian markets as opposed to net outflows for the month of October and November. In fact, staggering data coming in, Avinash, 22,766 crore rupees in the first 2 weeks of December as equity inflows in the Indian market. This also comes amid the sliding rupee. The INR versus the USD is pretty much at record lows. Now, is this again something to do with what is happening globally and the macroeconomic environment, where India continues to be a more positive, bullish economy to invest in by FIIs? Or are we just looking at expiry data and hence the markets have also seen the kind of swings and it's not really linked to the FII story?
No, I think clearly, FIs have been doing some value buying, and I think clearly this number is encouraging. I think we also need to understand that we need to, see a little more stability and consistency in these numbers. But one thing is very clear that Indian markets cannot be ignored for long, and I think looking at the fact that, Q3 numbers, according to me, are going to be much better than Q2. And plus the kind of money which is coming in primary markets, you see a lot of FI allocations, now going towards key primary market offerings also. So I think this secondary market buying plus some money, coming in the primary markets by FIs is definitely going to continue. I think markets will give some time. But hopefully, when January starts, I think you could possibly see a lot of pre-em buying, ahead of the budget and ahead of key corporate, Q3 numbers. So I think all said and done, whatever negatives had to happen, had to happen. I think there was some profit booking because valuations had shot up in a very small period of time. But today, I think it's going to be a stock specific approach. So FIs are also very selective in putting money in sectors like capital goods, housing, real estate, cement, autos. So I think, they're looking at key sectors. And this is not a all-round base kind of buying rally which they are doing. So I think it's better to wait for a couple of months. I think post March, April, we'll have better clarity. Once the US President Donald Trump also takes over, I think we're going to see a lot of commentary coming in, which eventually should benefit India, and that I think should go a long way in encouraging
Right.
FI flows to India. Yeah.
Right. So, of course, let's shift focus, Avinash, for a bit from FIIs and look at the QIPs, the qualified institutional placements, which have also hit a historic milestone in the year 2024. And this has surpassed 1 lakh crore rupees for the first time in a calendar year. In fact, Indian companies have raised over 1,21,321 crore rupees through QIPs by November. And this is an increase from the 52,350 crore rupees. In fact, more than doubled as compared to the previous year. Now, according to some analysts, Avinash, the sharp increase showed market resilience, and this has been a key factor in driving growth as companies continue to garner capital through QIPs. How are you viewing this increase in QIP from the year ago period, and what does this really tell us about the mood of the markets right now?
No, I think the increase in QIP is definitely a positive sign. See, institutional funds, FIs, mutual funds have been very active in the QIP market, largely because quality companies are issuing quality paper, and I think most of the companies which have raised QIP money are companies where the growth trajectory is very solid, the order book is very strong, and where the management commentary and the scalability of the business is very strong. So I think all these factors have made them attractive. And that is the reason I feel that, equity as an asset class is going to do well. I think when, large funds put money in QIPs, they normally take a 2 to 3 year view on any particular sector or company. So I think long-term money coming in the equity market is always a positive sign. It gives a lot of stability. And
Right.
plus, most of these corporates would benefit because, rather than debt funding, if a company issues equity, I think clearly the cost of equity is expensive in the longer term, but I think it's better than funding any project by means of debt. So I think to that extent, it's a positive development. But I think, yes, the markets have also taken it in a very positive way. Despite the supply of new quality paper, the markets have been resilient. There has been no untoward, selling in these kind of companies or sectors,
Right.
and shows that there's a huge appetite for the, paper from these FIs.